In this video, we'll be talking about the spread. So the spread is the difference between the buying price, which is the bid price, and selling price, also known as the ask price of a currency pair. The bid price is the price at which a trader can sell a currency pair, while the ask price is the price at which a trader can buy a currency pair. The spread is important because it represents the cost of trading Forex. Forex brokers make money by charging a spread on each trade that their clients make. The spread can vary depending on the currency pair being traded, the size of the trade, and the volatility of the market. Now here is an example. If the pound USD currency pair has a bid price of 1.3089 and an ask price of 1.3091, the spread will be 2 pips. This means that if a trader were to buy and immediately sell the pound USD currency pair, they will need the exchange rate to move by at least 2 pips in their favor in order to break even. Tight spreads are generally preferred by traders because they reduce the cost of trading and increase the potential profit from a trade. However, it's important to note that a tighter spread may come with other costs, such as higher commission fees or lower quality trade execution. The spread in Forex can vary depending on several factors, such as the liquidity of the currency pair, the trading volume, the time of day, and market volatility. Tight spreads are more likely to be seen during periods of high liquidity and low volatility. This usually occurs during the opening hours of major financial centers, when there is high volume on trading activity and many traders are buying and selling currency pairs. On the other hand, big spreads are more common during periods of low liquidity and high volatility. This can happen during major economic or political events that cause sudden fluctuation in the exchange rate, or when there is low trading volume due to holidays or market closures. It's also worth noting that different currency pairs can have different typical spread due to their liquidity and popularity. Major currency pairs, as mentioned in the course, such as Euro USD, USD JPY, and Pound USD, for example, tend to have tighter spreads because they are more heavily traded, while minor and exotic currency pairs may have wider spreads due to low liquidity.